Software is eating the world. The story of Andreessen Horowitz. July 2008. The financial world is collapsing. Bear Stearns has already failed. Lehman Brothers will be gone in 2 months. Every major bank is hemorrhaging billions. Venture capital firms are paralyzed, pulling back from new investments, trying to preserve capital, hoping their portfolio companies can survive without additional funding. But in Menlo Park, California, 2 men are doing something that seems completely insane. Marc Andreessen and Ben Horowitz are raising their first venture capital fund. Not a small experimental fund. Not a cautious entry into the market. They are targeting $300 million at the worst possible moment in modern financial history. Every smart person they know tells them they are crazy. The venture capital industry is contracting. Limited partners are not writing checks. The IPO market is frozen. Exit multiples have collapsed. This is exactly the wrong time to start a new fund. But Andreessen and Horowitz see something different. They see that in 6 to 12 months, when the panic subsides, there will be extraordinary companies desperate for capital. Companies with great products and real traction but no access to funding because everyone else pulled back. These companies will need believers. They will need partners who understand technology deeply and can help them survive the crisis and emerge stronger. More importantly, Andreessen and Horowitz have a thesis that goes far beyond crisis opportunism. They believe that software is about to eat the world. That every industry, every company, every aspect of business and life is going to be transformed by software over the next decade. That the entrepreneurs building these software companies need a different kind of venture capital firm. One founded and operated by people who have actually built technology companies. Who have lived through the chaos of startups. Who understand what founders face at 3 in the morning when everything is breaking. This is not just about investing. This is about building a new kind of institution. One designed from first principles around a single question: what would venture capital look like if it was built to serve founders rather than investors? They will call it Andreessen Horowitz. Within 5 years, it will become the most influential venture capital firm of the 21st century. Within 10 years, it will manage over $20 billion and redefine how venture capital operates. But in July 2008, it is just 2 guys with a crazy idea, trying to raise money in the worst financial crisis since the Great Depression. This moment reveals everything about what made them different. While others saw risk, they saw opportunity. While others retreated, they advanced. While others preserved the old model, they built something new. Their willingness to launch at the bottom of the market was not courage or recklessness. It was conviction born from experience. They had seen this pattern before. The best companies are often founded in the worst times. When everyone else is afraid, that is when the greatest opportunities emerge. But this decision to launch in the crisis reveals something deeper about their philosophy. They believed that venture capital had become too focused on the financial engineering of deals and not focused enough on the human reality of building companies. That most VCs treated founders as necessary inputs into an investment portfolio rather than as partners in creation. That the industry had lost touch with what actually matters in technology: the quality of the product, the vision of the founder, the potential to transform entire industries. Andreessen and Horowitz had lived the founder experience. Marc had co-founded Netscape at age 22 and watched it grow from nothing to a public company worth billions before being acquired by AOL in a complex deal that taught him how venture capital and big tech actually work. Ben had been a senior executive at Netscape and then co-founded Loudcloud with Marc, taking it public and then selling the managed services business to EDS before transforming the remaining software assets into Opsware, which they eventually sold to Hewlett-Packard for $1.6 billion. They had raised venture capital. They had pitched their companies. They had fought to survive. They had made payroll when the bank account was nearly empty. They had fired executives who were not working out. They had navigated acquisitions and IPOs. They had lived through the dot-com crash and the recovery. They knew what founders needed because they had needed it themselves. This experience gave them a clarity about what was broken in venture capital. Most VCs came from business school or investment banking. They understood financial models and market analysis. But they did not understand the actual work of building a technology company. The technical decisions, the product trade-offs, the hiring challenges, the competitive dynamics, the operational crises that happen every week. Most VCs could analyze a business plan but could not help a founder debug their growth engine or restructure their engineering team. So when Andreessen Horowitz decided to start their firm, they began with a simple principle: build the firm that they wished had existed when they were founders. A firm run by people who had actually done it. A firm that provided real operational help, not just money and board seats. A firm that treated founders as the heroes of the story, not as service providers to investors. A firm that would be unambiguously on the side of the entrepreneur. This was radical. The traditional venture capital model put investors first. The GP managed the LP's money and the founder was the instrument for generating returns. The power dynamic was clear: investors had the capital, founders needed it, so investors controlled the terms. Most venture capital firms operated as investment committees where partners voted on deals and built consensus. This meant that founders had to convince not just one partner but the entire partnership, and even after investment, major decisions required committee approval. Andreessen Horowitz rejected this model entirely. They would operate as a generalist firm where individual partners had full authority to make investment decisions up to a certain amount. No committees. No consensus building. If a partner believed in a founder and a company, that partner could write the check. This meant founders pitched one person who could say yes, not a group that had to agree. It meant speed. It meant conviction. It meant that the best founders would get term sheets from a16z faster than from anywhere else. They also rejected the traditional venture capital focus on financial engineering and deal terms. Most VCs spent enormous time negotiating liquidation preferences, anti-dilution provisions, board control, and protective provisions. These terms were designed to protect the investor in downside scenarios. But Andreessen Horowitz believed this was backwards. The only way to make exceptional returns in venture capital is to invest in companies that become huge successes. In those cases, the deal terms do not matter much. What matters is getting into the right companies at reasonable prices and helping them succeed. So a16z would use standardized term sheets with founder-friendly terms. They would not nickel and dime on valuation or extract onerous terms. They would move fast, offer clean terms, and focus their energy on helping the company succeed after investment rather than on protecting themselves in the investment documents. This approach was not naive. It was strategic. The best founders have multiple options for capital. They choose investors based on who can help them most. By offering speed, simplicity, and support, a16z could win deals that other firms could not. But the most radical innovation was what they called the operating partner model. Traditional venture capital firms were small. Maybe 10 to 15 investment partners and a handful of administrative staff. The partners spent their time finding deals, sitting on boards, and managing their portfolios. If a portfolio company needed help with recruiting, marketing, business development, or operations, the partner would try to help but usually lacked the specific expertise needed. Andreessen Horowitz decided to build something completely different. They would hire dozens of operational experts, recruiters, marketers, engineers, executives, and make them available to all portfolio companies. If a founder needed to hire a CFO, a16z would have recruiting partners who specialized in finding finance executives for startups. If a company needed to set up their sales process, a16z would have sales experts who had built sales teams at successful companies. If a founder was struggling with product market fit, a16z would have product leaders who could advise. This was expensive. Most venture capital firms operated with very lean overhead because expenses reduced returns. But Andreessen Horowitz believed that by helping their company succeed, they would generate better returns even after accounting for higher costs. They were willing to earn less on the management fee side in order to earn more on the carry side by building better companies. The operating partner model also solved a structural problem in venture capital. Most VCs sit on 8 to 12 boards. They have one board meeting per company per month or quarter. That means they see each company for a few hours every few weeks. In between, they are largely unavailable because they are meeting with other portfolio companies or looking at new deals. Founders are left on their own for the actual work of building the company. By having a large team of operating partners who did not have board seats and were not looking at new deals, a16z could provide continuous support. A founder could email or call an operating partner anytime and get real help. This was not theoretical advice from someone who had invested in similar companies. This was practical guidance from someone who had done the specific job the founder was trying to do. The bet was that great founders would choose a16z over other firms because they valued this support. That by delivering real value beyond capital, a16z would get access to the best deals. That access to the best deals would generate superior returns. That superior returns would allow them to raise larger funds. That larger funds would allow them to hire more operating partners. That more operating partners would make them even more valuable to founders. It was a flywheel strategy, and everything depended on the initial bet being correct. In 2008 and 2009, as they raised their first fund, this model was unproven. They had no track record as venture capitalists. They had credibility as founders and operators, but being a good founder does not automatically make someone a good investor. Many successful founders have tried to become VCs and failed. The skills are different. Founders need to be focused, obsessive, willing to ignore doubt and push through obstacles. Investors need to be diversified, analytical, willing to say no to most opportunities and maintain conviction without certainty. But Andreessen Horowitz had something that gave limited partners confidence. They had a clear thesis about the future. They articulated it simply: software is eating the world. They believed that software would transform every industry over the next decade, the way it had already transformed media, communication, and entertainment. That the tools for building and distributing software had become so much better and cheaper that a new generation of software companies would emerge in every sector. That these companies would disrupt incumbents and create enormous value. This thesis was contrarian in 2008. The dot-com crash was still fresh in memory. People associated internet companies with hype and failure. The big technology successes of the previous decade had been Google and Facebook, and even Facebook was still private and unproven as a business. Most investors were skeptical that software could really disrupt industries like transportation, hospitality, healthcare, or finance. These were heavily regulated, capital-intensive, relationship-driven businesses. Software seemed unlikely to change them fundamentally. But Andreessen Horowitz saw the infrastructure being built. Cloud computing meant startups no longer needed to buy servers. They could rent capacity from Amazon Web Services and scale up or down instantly. Open source software meant startups could use free, high-quality tools instead of paying for expensive enterprise software. Mobile devices meant every person would soon carry a powerful computer connected to the internet. APIs and platforms meant startups could integrate with existing services instead of building everything from scratch. All of these trends meant that the cost of starting a software company had fallen by a factor of 10 or more. In the 1990s, you needed millions of dollars just to buy the servers and software licenses to build a basic web application. By 2008, you could build and launch a product with a few $100,000 or less. This meant more experimentation, more startups, more shots on goal. And it meant that software companies could get to market faster, learn faster, and iterate faster than ever before. This was the environment that Andreessen and Horowitz were built to exploit. They understood the technology deeply. They could evaluate technical architecture and product strategy in ways that most VCs could not. They knew which problems were hard and which were just tedious. They could tell the difference between a real technical innovation and vaporware. And they had the operational experience to help founders navigate the journey from idea to scale. So in the depths of the financial crisis, while others were paralyzed, they moved forward. They closed their first fund at $300 million in 2009. It was smaller than they had hoped, but enough to start. They set up their offices on Sand Hill Road in Menlo Park, the traditional home of Silicon Valley venture capital. But they did not try to blend in with the traditional firms. From the beginning, they signaled that they were different. Their office design rejected the wood-paneled, country club aesthetic of traditional VC firms. They wanted something that felt more like a startup. More energy. More creativity. Less formality. They hired aggressively, building their operating partner team from the start. They launched a blog and began publishing their thinking about technology, markets, and startups. Marc's blog posts, in particular, became required reading in Silicon Valley. They were sharp, contrarian, and deeply informed. They established a16z as intellectual leaders, not just capital allocators. And they started investing. Their first investments came from their network. Entrepreneurs they knew from Netscape and Opsware. Founders in the Valley who had heard about their plans and wanted to work with them. Within months, they had backed Skype, which was already a large company but needed growth capital. They invested in Foursquare, the location-based social network that was generating buzz. They backed Lytro, a camera company trying to revolutionize photography. They invested in enterprise software companies that were building tools for the cloud era. The portfolio was eclectic. Consumer and enterprise. Software and hardware. Early stage and growth stage. But there was a thread connecting everything. These were technology companies going after big markets with technical innovation and strong founders. They were not incremental improvements. They were attempts to fundamentally change how things worked. Some of these early bets would succeed dramatically. Some would fail. But collectively, they established a16z as a firm willing to take risks on ambitious founders pursuing transformative ideas. And as they built their portfolio, they built their brand. Every blog post, every hire, every investment decision reinforced the message: this is a different kind of venture capital firm. This is a firm built by founders for founders. This is a firm that understands technology. This is a firm that can help you win. By 2010 and 2011, the financial crisis was over and venture capital was coming back. But the landscape had changed. The old model of small, clubby partnerships making careful, consensus-driven investments was being challenged by a new generation of firms. And at the center of that new generation was Andreessen Horowitz, growing faster and making bolder bets than almost anyone else. But to understand why they succeeded, we need to go back further. We need to understand where Marc Andreessen and Ben Horowitz came from. What formed their thinking? What experiences shaped their philosophy? Why they saw opportunities that others missed. The story of a16z begins long before 2008, in the personal histories of its founders and the technological revolutions they lived through. Marc Andreessen was born in 1971 in Cedar Falls, Iowa. His father was a salesman and his mother worked for Land's End. The family was middle class. Comfortable but not wealthy. Marc grew up in New Lisbon, Wisconsin, a small town of about 2,000 people. There was not much technology around. No computers at school. No internet, because the internet did not exist yet in a form civilians could access. But Marc was fascinated by computers from an early age. He read everything he could find about them. He taught himself to program. When his high school got a computer lab, he spent every free moment there. He was not particularly social. He was awkward, intense, intellectually curious in ways that did not fit easily into small-town Wisconsin culture. But he had found something that captured his imagination completely. He went to the University of Illinois at Urbana-Champaign, one of the best engineering schools in the country. He studied computer science. And he got a job at the National Center for Supercomputing Applications, known as NCSA, which was one of the leading research centers for high-performance computing. This was the early 1990s. The internet existed but was mostly used by academics and researchers. There was email and file transfer and some text-based communication tools. But there was no easy way to navigate between different information sources. no way to click on something and jump to related content. In 1991, Tim Berners-Lee at CERN in Switzerland released the World Wide Web, a system for linking documents together over the internet using hypertext. He created the first web browser and web server. But the browser was difficult to use and only ran on specific machines. Most people could not access it. Marc saw the web demos and immediately understood that this could be huge. If you could make a browser that was easy to use and ran on regular computers, you could make the internet accessible to everyone. You could turn all the world's information into a connected web that anyone could explore. This was 1992. Marc was 21 years old, an undergraduate student working part-time at NCSA. He started working with a full-time programmer at NCSA named Eric Bina. Together, they built Mosaic, a web browser that had a graphical interface and ran on the computers most people actually used. You could click on links. You could see images inline with text. You could navigate easily. It was not the first web browser, but it was the first one that regular people could actually use. They released Mosaic in early 1993. It spread like wildfire. Within months, hundreds of thousands of people were downloading it. Within a year, millions. It was the first time most people had ever experienced the web. And it changed everything. Suddenly the internet was not just for researchers. It was for everyone. You could publish information and anyone in the world could access it instantly. You could build applications and services that reached global audiences. Marc graduated and moved to Silicon Valley to work at a company. But he knew that Mosaic was the beginning of something huge. He started thinking about what a commercial web browser company could look like. In 1994, he met Jim Clark, who had founded Silicon Graphics and was looking for his next big thing. They decided to start a company together to build a commercial web browser and web server. They called it Netscape. Marc was 22. He was a founder and chief technology officer of a company that was going after one of the biggest opportunities in the history of technology, making the internet accessible to everyone. Netscape raised venture capital. They hired aggressively. They built a better browser than Mosaic, faster and more stable, with more features. They gave it away for free to consumers and sold server software to businesses. They grew explosively. In 1995, less than 2 years after the company was founded, Netscape went public. The IPO was supposed to price at $14 per share. The underwriters raised it to $28 because demand was so strong. On the first day of trading, the stock opened at $75 and closed at $58, giving the company a market value of nearly $3 billion. Netscape had less than $100 million in revenue at the time. The Netscape IPO marked the beginning of the internet boom. It showed that internet companies could create enormous value very quickly. It made Marc Andreessen famous. He was on the cover of Time magazine, barefoot, sitting in a chair, looking like the embodiment of the new digital generation. He was 24 years old. But the next few years taught Marc hard lessons about how technology and business actually work. Microsoft saw Netscape as a threat. Bill Gates wrote his famous Internet tidal wave memo, redirecting Microsoft to focus on the Internet. Microsoft built Internet Explorer and bundled it with Windows for free. They used their monopoly in operating systems to push Netscape out. Netscape fought back. They tried to innovate faster. They tried to build a platform for web applications. They tried to diversify into other products. But Microsoft was too powerful. They had unlimited resources and they controlled the distribution channel. By 1998, Netscape's browser market share was collapsing. The company needed an exit. AOL acquired Netscape for about $4 billion. It was not the triumphant outcome Marc had hoped for. Netscape had changed the world. They had made the web accessible to hundreds of millions of people. They had shown that internet software could be a huge business. But they had been crushed by Microsoft's monopoly power. And Marc learned that even great technology is not enough. You need strategy. You need distribution. You need to understand the competitive dynamics and the power structures in your industry. After the acquisition, Marc stayed at AOL for a while but was frustrated. He wanted to build something new. He started talking with Ben Horowitz, who he had worked with at Netscape. Ben had been a senior executive there and had lived through the same battles. They shared a view that the internet was still early, that the first wave had been about access and communication. But the next wave would be about applications. About software delivered over the internet that could replace traditional enterprise software and consumer applications. Ben Horowitz had a different background from Marc. He was born in 1966 in London to American parents. His father was a prominent communist who had been blacklisted during the McCarthy era and moved to London to continue his political work. The family moved back to the United States when Ben was young, settling in Berkeley, California. Ben grew up in a highly political, intellectual environment. His father knew many of the major left-wing intellectuals and activists of that era. Ben went to Columbia University, where he studied computer science. He was a good student but also loved hip-hop music and culture. He was the kind of person who could move between different worlds, the academic world of computer science, the cultural world of music, the business world of technology startups. This ability to connect different domains would later become one of his strengths as an operator and investor. After college, Ben worked at Silicon Graphics, where he met Marc Andreessen. He then joined Netscape, where he rose to become vice president of product management. He was responsible for overseeing the development of key products and managing relationships with enterprise customers. He learned how large organizations make technology decisions, how to sell to them, how to build products they actually need rather than products that sound cool but do not solve real problems. When Marc wanted to start a new company in 1999, he asked Ben to co-found it with him. They called it Loudcloud. The idea was to provide infrastructure services for internet companies. In the late 1990s, running web applications required buying expensive servers, installing them in data centers, configuring them, managing them, and scaling them as your traffic grew. This was expensive and complicated. Many startups could not afford it. Many enterprise companies did not have the expertise. Loudcloud would do it for them. They would build a platform for running web applications at scale. They would manage all the infrastructure. Customers would just write their application code and Loudcloud would handle everything else. It was essentially the idea of cloud computing before that term existed. Amazon Web Services would not launch until years later. Loudcloud was trying to create that model. They raised huge amounts of money. The internet bubble was still inflating in 1999 and early 2000. Venture capitalists were desperate to invest in anything internet-related. Loudcloud raised $120 million in multiple rounds. They hired hundreds of people. They built massive data centers. They signed up big customers. And then the bubble burst. In March 2000, the Nasdaq peaked and then started falling. By 2001, it had lost nearly 80% of its value. Internet companies were going bankrupt every week. Loudcloud's customers were disappearing. Revenue was collapsing. They were burning through cash at an unsustainable rate. Ben and Marc faced a brutal reality. They had hundreds of employees counting on them. They had investors who had put in $120 million. They had customers who depended on their service. But they were running out of money and the market for raising capital had frozen. They needed to survive, but they were not sure how. They decided to take Loudcloud public, even though the market was terrible and the company was not ready. In March 2001, they went public at $6 per share, well below the private valuation. It was one of the worst IPO markets in history. But they raised the capital they needed to stay alive. Then they had to figure out how to build a sustainable business. The managed services business that Loudcloud had built was capital-intensive and low margin. They were essentially running data centers for customers, which required huge infrastructure investment and generated thin profits. They needed something better. They realized that the software they had built to manage their infrastructure was valuable. They had created a platform for automating server provisioning, configuration, monitoring, and scaling. This software could be sold to enterprises who wanted to manage their own infrastructure more efficiently. They decided to spin off the managed services business and focus entirely on the software. In 2002, they sold the managed services business to Electronic Data Systems for $63 million. This gave them capital to survive. They renamed the remaining software company Opsware and focused on building the best data center automation software in the market. The next few years were hard. They were competing against much larger companies like IBM and HP who had their own infrastructure management software. They had to rebuild their sales force. They had to convince enterprises to trust a small, struggling company with critical infrastructure. Ben was CEO and he was learning on the job how to run a public company, manage a board, hit quarterly targets, and still build for the long term. But they executed well. Opsware built a great product. They signed big customers. They grew revenue steadily. By 2007, they were doing over $100 million in revenue and were finally profitable. Hewlett-Packard saw them as a strategic asset. HP wanted to build a cloud computing platform and Opsware's software was a key piece. HP acquired Opsware for $1.6 billion. This outcome was remarkable. Marc and Ben had started a company at the peak of the bubble. They had lived through its crash. They had nearly gone bankrupt multiple times. They had pivoted the business model. They had fought against much larger competitors. And they had ultimately sold the company for more than $1 billion, generating strong returns for investors and life-changing wealth for employees. But more important than the money was the education. Marc and Ben had now built 2 companies from scratch. They had raised venture capital multiple times. They had navigated IPOs and acquisitions. They had hired and fired executives. They had pivoted business models. They had dealt with technical debt, sales cycles, customer churn, competitive threats, board dynamics, and all the other challenges that founders face. They knew what it felt like to be running out of money. They knew what it felt like to have employees question your decisions. They knew what it felt like to lose a major customer. They knew what it felt like to launch a product that nobody bought. They knew what it felt like to fire someone you really liked but who was not performing. They knew the emotional roller coaster of building a company. And they had seen how VCs actually behaved. Some of their investors had been helpful, providing good advice and support. But many had been passive or worse, adding stress without adding value. Very few understood the operational challenges well enough to provide practical help. Most board meetings focused on financial metrics and strategy at 30,000 feet, not on the actual problems that were preventing the company from executing. Marc and Ben believed they could be better investors because they had lived the founder experience. They knew what questions to ask. They knew what problems were real and what problems were just noise. They knew when to push and when to back off. They knew how to help a founder think through a strategic decision without imposing their own will. They knew how to add value. So when they started thinking about their next act, venture capital made sense. They could deploy the pattern recognition they had built over 15 years. They could help the next generation of founders avoid the mistakes they had made. They could build the firm they wished had existed when they were founders. And they could do it at scale, helping dozens of companies rather than just building one. But they did not want to be traditional VCs. They did not want to sit in board meetings and review financial models. They wanted to build an institution that could actually help founders win. And they had ideas about how to do that differently. This brings us back to 2008 and the decision to launch in the crisis. Marc and Ben had capital from selling Opsware. They had credibility in Silicon Valley. They had relationships with successful founders and executives. They had a thesis about where technology was going. They had conviction that the old venture capital model was broken and could be improved. And they had timing. The financial crisis created a moment when the rules were being rewritten. When limited partners were looking for new managers who could generate returns in a changed world. When founders were looking for investors who understood that the old playbooks did not work anymore. When there was space to try something radically different. So they launched. And over the next 15 years, they built Andreessen Horowitz into one of the most influential institutions in technology. They invested in Facebook when it was still private. They invested in Twitter. They invested in Groupon and Zynga during the social media wave. They invested in GitHub and Okta and Instacart. They invested in Coinbase and Lyft and Slack. They invested in hundreds of companies, many of which became unicorns, companies valued at over $1 billion. But more than the portfolio, they changed how venture capital works. They proved that the operating partner model could work. That founders valued support enough to choose a16z even when other firms offered higher valuations. They proved that you could build a large, professional services organization within a venture capital firm and still generate top-tier returns. They proved that marketing and brand building mattered in venture capital. They proved that being founder-friendly and transparent could be a competitive advantage. They also changed the culture of Silicon Valley. Their blog posts and public statements articulated ideas that became widely adopted. The concept of product-market fit, which was popularized by Marc's writing. The importance of founder mode versus professional management mode. The distinction between wartime and peacetime CEOs, which Ben described in his book. These frameworks became part of how the Valley thinks about building companies. And they trained a generation of investors. People who worked at a16z in the early years went on to start their own firms or become partners at other top firms. They spread the operating partner model and the founder-first philosophy. They made venture capital more professional, more service-oriented, more focused on actually helping companies rather than just allocating capital. But their success also created challenges. As they raised larger funds, they had to invest more capital per company to deploy those funds. This meant they were writing bigger checks, often leading to higher valuations and more competition for deals. It meant they had to be right about fewer companies, because they were more concentrated. It meant they needed companies to achieve huge outcomes to generate returns, not just good outcomes. They also faced the challenge that all successful venture firms face: how to maintain the culture and the edge as you grow. In the early days, it was just Marc and Ben and a handful of partners making every decision together. By the 2020s, they had dozens of investing partners, hundreds of employees, multiple offices, and billions of dollars under management. How do you maintain the speed, conviction, and founder focus when you are a large institution? These are the questions that will determine whether a16z can continue to be exceptional or whether they will regress to the mean like most successful venture firms eventually do. But before we explore their current state and future, we need to understand the key historic moments and investments that shaped their trajectory. We need to see how their philosophy was tested and refined through actual experience in the market. The first major era for Andreessen Horowitz was from 2009 to 2012, when they were building their initial portfolio and establishing their brand. This was the recovery from the financial crisis, the rise of social media, the mobile revolution, and the beginning of the cloud era. It was a time of enormous opportunity and enormous change. When they launched in 2009, social media was already a dominant force. Facebook had over 200 million users and was growing fast. Twitter was becoming the real-time information network for the world. YouTube had been acquired by Google and was transforming media consumption. But most investors still saw social media as consumer toys, not serious businesses. The revenue models were unclear. The idea that social networks could become the primary way billions of people communicated and consumed information seemed like hype. Marc and Ben saw it differently. They believed that social networks were building massive distribution platforms. That once you had hundreds of millions of users coming to your platform every day, you could monetize that attention in multiple ways. That advertising would work at scale. That social platforms could become the new media companies, displacing traditional television, newspapers, and magazines. In 2009, they made one of their first major investments, Skype. Skype was already a large company with over 400 million registered users and about $700 million in annual revenue. It had been acquired by eBay in 2005 for $2.6 billion, but the acquisition had not gone well. eBay was trying to spin it off. A consortium of investors including Index Ventures and Silver Lake was buying it out. Andreessen Horowitz invested $49 million from their first fund, a huge bet for a first-time fund. But Marc and Ben believed that Skype was undervalued. That internet-based communication was the future. That Skype had built something incredibly valuable, a massive user base and a global communication network that worked across all devices and platforms. Within 2 years, Microsoft would acquire Skype for $8.5 billion, generating a strong return for a16z. The Skype investment showed their willingness to do things differently. Most early-stage VCs focused on seed and Series A investments in very young companies. Writing $49 million checks into mature companies was typically the domain of growth equity firms or private equity firms. But a16z believed that the traditional stage boundaries were arbitrary. If they could add value and generate returns, they would invest at any stage. They also invested in Foursquare, the location-based social network that let you check in at physical locations and share where you were with friends. Foursquare was generating enormous hype in 2010 and 2011. It was one of the first mobile-first social networks. It showed that smartphones with GPS could enable entirely new kinds of social applications. Every cool person in New York and San Francisco was using it. A16z led Foursquare Series B in 2010, investing $20 million at a valuation of less than $100 million. They believed that location data would become incredibly valuable. That knowing where people were and where they went could enable new forms of advertising, commerce, and services. They were right about the thesis, but Foursquare struggled to build a sustainable business model. The check-in mechanic got old. Users stopped opening the app. Competition from Facebook and Google made it hard to differentiate. Foursquare would eventually pivot to become a location data and technology company, selling its data and software to other businesses. It would not become the massive consumer success that early believers hoped. But it would survive and find a sustainable niche. The investment would ultimately return some multiple of capital, but not the explosive return they had hoped for. It was a lesson in the difficulty of building consumer social networks. You need to not just invent a new behavior but make it sticky enough that people keep doing it even when the novelty wears off. Their biggest bet in the social media era was Facebook. By 2010, Facebook was clearly the dominant social network. It had over 500 million users. It was growing in every country. Mark Zuckerberg had turned down a $1 billion acquisition offer from Yahoo in 2006, betting that he could build something much bigger. He had been proven right. Facebook was now raising growth capital to accelerate expansion and was being valued as one of the most important technology companies in the world. A16z wanted in. They met with Zuckerberg and the Facebook team. They made their pitch: we understand social networks, we understand scaling consumer internet companies, we can help you think through strategic questions, we want to partner with you for the long term. Facebook was raising a round at a valuation that made some investors nervous. The company was valued at over $10 billion despite revenue that was still modest compared to that valuation. But Marc and Ben were willing to pay the price. In 2010, A16z invested just under $100 million in Facebook. It was an enormous bet for their first fund, nearly 1/3 of the total fund size committed to a single company. If Facebook failed, their fund would have mediocre returns no matter how well their other investments did. But if Facebook succeeded at the scale they believed possible, this single investment could return the entire fund multiple times over. They were right. Facebook went public in 2012 at a valuation of over $100 billion. It has since grown to a market cap of over $800 billion. The A16z investment in 2010 would ultimately be worth over $3 billion, one of the best venture capital investments of all time. It returned their entire first fund multiple times over from a single investment. But the Facebook investment was not just about returns. It established A16z as a firm that could win competitive deals with the best companies. It showed that they could move quickly and pay up when necessary. It showed that Marc's personal relationship with Zuckerberg and his credibility as someone who had built Netscape gave A16z access that other firms could not replicate. And it showed the power of conviction. Most VCs would not have concentrated 1/3 of a fund in a single company, especially at a valuation that seemed high. But Marc and Ben believed so strongly in Facebook's potential that they were willing to take that risk. This willingness to concentrate in their highest conviction ideas would become a hallmark of how they invested. Around the same time they were investing in social networks, they were also building a portfolio of enterprise software companies. This was less flashy but ultimately became an even bigger part of their strategy. Marc's thesis about software eating the world applied as much to enterprise as to consumer. He believed that traditional enterprise software was going to be disrupted by cloud-based software as a service companies that delivered better products at lower prices with easier implementation. They invested in GitHub, the platform for software developers to store and share code. GitHub was not flashy. It was a developer tool. But it was becoming essential infrastructure for modern software development. Every serious engineering team used it. It was free for open source projects and charged for private repositories. The business model was clear. The product was loved by users. And it was building a network effect. The more developers used GitHub, the more valuable it became, which attracted even more developers. A16z invested in GitHub's Series A in 2012, putting in $100 million at a valuation of around $750 million. It was a huge Series A, reflecting both the company's traction and A16z's willingness to write big checks. GitHub would eventually be acquired by Microsoft for $7.5 billion in 2018, generating a strong return for A16z. They also invested in Okta, a company building identity management software for enterprises. Okta was solving a boring but critical problem: how do you manage who has access to which applications in a company? As companies adopted dozens or hundreds of cloud applications, they needed a centralized way to manage logins, permissions, and security. Okta built that platform. A16z led Okta's Series A in 2011. The company would go public in 2017 and would eventually be valued at over $30 billion at its peak. Another massive success in enterprise software that validated their thesis about cloud-based infrastructure. The pattern across these investments was consistent. A16z was looking for companies that were building platforms or infrastructure that could become essential to how the internet worked. Social networks as attention platforms. Cloud services as computing infrastructure. Developer tools as software creation infrastructure. Identity management as security infrastructure. These were not one-time products. They were foundational layers that other businesses would be built on top of. This was a sophisticated investment strategy. Platforms and infrastructure companies are harder to build than point solutions. They take longer. They require more capital. They face more competition. But when they succeed, they create durable competitive advantages. Once a platform has network effects or high switching costs, it becomes very hard to displace. And the value creation can be enormous. Marc and Ben understood this from their own experience. Netscape had tried to build a platform for web applications. Opsware had built infrastructure for data center automation. They knew how platforms worked and what made them defensible. They could evaluate whether a young company was actually building a platform or just claiming to. And they could help founders think through the strategic choices that determine whether a platform succeeds. But not every investment worked. Lytro, the light field camera company, was one of their early bets that failed. Lytro had invented a new kind of camera that captured more information about light than traditional cameras. This allowed you to refocus a photo after you took it. You could change the depth of field. You could create three-dimensional images. It was genuinely innovative technology. A16z invested in Lytro's Series B in 2011, putting in about $50 million. They believed that computational photography was the future. That cameras would become more about software and processing than about lenses and sensors. That Lytro could create a new category of imaging products. But Lytro struggled to find product-market fit. The first consumer camera they released was expensive and produced low-resolution images. Consumers did not care enough about refocusing photos to justify the cost and quality trade-offs. They tried pivoting to professional cinema cameras. This was technically impressive, but the market was too small and the sales cycle too long. Lytro eventually shut down in 2018, selling some assets but returning little value to investors. The Lytro failure taught important lessons. Technology innovation alone is not enough. You need a product that solves a problem people actually have and are willing to pay for. You need a distribution channel that can reach customers efficiently. You need a business model that can scale. Lytro had the technology but struggled with everything else. A16z also had misses in social media. They invested in Ning, a platform for creating social networks. The idea was that everyone would want to create their own custom social network for their specific community or interest. But Facebook became so dominant that most people did not want to use multiple social networks. Ning found some niche success but never became the massive platform they had hoped for. They invested in Digg, the social news aggregation site that had been very popular in the mid-2000s but was declining by the time a16z invested in 2011. They tried to help Digg reinvent itself, but it was too late. The product had lost its relevance and rebuilding momentum proved impossible. Digg was eventually sold for pieces. These failures were painful but instructive. They showed that even with great investors and strong support, some companies cannot be saved. Sometimes the market has moved on. Sometimes the product is not good enough. Sometimes the team cannot execute. Venture capital is a hits business. You are going to have many failures. The question is whether your winners are big enough to more than compensate. For a16z, their winners in the first era were big enough. Facebook alone returned the fund multiple times. The combination of Facebook, GitHub, Okta, Skype, and several other successful investments made their first fund one of the best-performing venture funds of its generation. By the time they raised their second fund in 2011, they had credibility not just from their own operating backgrounds but from demonstrated success as investors. The second fund was $1 billion, more than triple the size of the first fund. This reflected both their track record and their ambitious vision for what a venture capital firm could be. They were not content to be a small, boutique partnership. They wanted to build an institution that could operate at scale across the entire technology industry. This brings us to the second major era, 2013 to 2016, when a16z was scaling rapidly and expanding into new areas. This was the era of mobile becoming dominant, cloud infrastructure maturing, and new categories like cryptocurrencies and artificial intelligence beginning to emerge. The mobile revolution was one of the most important technological shifts of this period. The iPhone had launched in 2007. Android had launched in 2008. But it took several years for smartphones to reach mass adoption. By 2013, over half of Americans had smartphones. Globally, billions of people were coming online for the first time through mobile devices, skipping the PC era entirely. This created massive opportunities. Apps that would have been impossible or impractical on desktop suddenly made sense on mobile. Location-based services worked because your phone knew where you were. Photo and video apps worked because your phone had a good camera. Social apps worked because your phone was always with you. Commerce apps worked because your phone had payment capabilities. A16z invested aggressively in mobile. They backed Lyft, the ride-sharing company competing with Uber. Lyft was founded in 2012 by Logan Green and John Zimmer. The idea was simple: let people use their smartphones to request rides from ordinary people using their personal vehicles. This had been tried before with taxi apps and earlier ride-sharing experiments, but smartphones with GPS and mobile payments made it actually work. A16z led Lyft Series A in 2013, investing about $3 million. They saw that urban transportation was broken. Taxis were expensive, unreliable, and often unavailable when you needed them. Lyft could provide a better experience at a lower price by tapping into the massive supply of idle vehicles and drivers. The unit economics made sense if you could get enough scale. But Lyft faced brutal competition from Uber, which was better funded and more aggressive. Uber was raising enormous amounts of capital and using it to subsidize rides, acquire drivers, and fight regulatory battles in every city. Lyft had to do the same just to survive. This meant burning cash at unsustainable rates and raising multiple rounds of financing at valuations that had to keep going up to attract capital. A16z kept investing. They participated in multiple follow-on rounds, putting in hundreds of millions of dollars as Lyft grew. They helped recruit executives. They provided strategic advice on how to compete against Uber. They helped with regulatory strategies and public relations. This was the operating partner model in action, providing continuous support beyond the initial check. Lyft eventually went public in 2019 at a valuation of about $24 billion. It has since struggled as a public company, with its market cap fluctuating significantly as the profitability of ride-sharing has proven elusive. But the investment will still likely generate strong returns for a16z given their early entry price. Whether it will be a truly massive home run like Facebook remains unclear. They also invested in Instacart, the grocery delivery service. Same concept, use mobile technology to connect people who want groceries delivered with people willing to shop and deliver them. Instacart launched in 2012 and a16z led their Series A in 2013. Again, this was about enabling a service that was theoretically possible before but only practical with smartphones and modern payment systems. Instacart scaled rapidly. They partnered with existing grocery stores rather than trying to build their own inventory, which allowed them to expand quickly. They focused on operational excellence, training shoppers, optimizing routing, handling customer service issues. And they benefited from the shift toward online grocery shopping, which accelerated dramatically during the COVID-19 pandemic. Instacart went public in 2023 at a valuation of about $10 billion. Like Lyft, it has been challenging as a public company with questions about long-term profitability. But the investment has likely generated strong returns for a16z given their early entry. A third major mobile investment was Coinbase, though Coinbase is as much about cryptocurrencies as about mobile. Coinbase was founded in 2012 by Brian Armstrong and Fred Ursum as a simple way to buy and sell Bitcoin. At that time, buying Bitcoin was complicated. You had to wire money to shady exchanges or meet people in person. There was no easy, trustworthy way for ordinary people to acquire cryptocurrency. Coinbase built that. They created a simple interface that looked and felt like a normal financial app. They handled the complicated technical parts. They dealt with regulatory compliance. They made it as easy to buy Bitcoin as to buy a stock. And they focused on being trustworthy and legitimate, which was rare in the cryptocurrency world at that time. A16z invested in Coinbase Series B in 2013, putting in $25 million. This was controversial. Many people, including many in Silicon Valley, thought cryptocurrencies were a scam or a bubble. The idea that digital tokens with no intrinsic value could become a new form of money seemed absurd. Bitcoin's price was volatile. The main use cases seemed to be speculation and buying drugs on the dark web. But Marc and Ben believed that Bitcoin represented something genuinely new, a decentralized, global, digital form of money that no government or company controlled. They believed that this could be transformative, especially in countries with weak currencies or authoritarian governments. They believed that the blockchain technology underlying Bitcoin could enable new kinds of applications and organizations. And they believed that cryptocurrencies would become an important asset class that institutions and individuals would want to own. They were early to this thesis. In 2013, most serious investors were dismissive of Bitcoin. But a16z was willing to take a very contrarian bet. They invested not just in Coinbase but in dozens of cryptocurrency and blockchain companies over the following years. They launched a dedicated cryptocurrency fund. They became one of the most prominent advocates for crypto in mainstream finance and technology circles. The Coinbase investment has been spectacularly successful. The company went public in 2021 at a peak valuation of over $80 billion during the cryptocurrency boom. The valuation has since fallen significantly as crypto prices crashed, but Coinbase remains the leading cryptocurrency exchange in the United States. The a16z investment has likely generated returns of well over $10 billion, making it one of their best investments ever. But the crypto investment also created controversy. Critics argue that cryptocurrencies are speculative assets with little real utility. That they are used primarily for tax evasion, money laundering, and ransomware payments. That the enormous energy consumption of proof-of-work blockchains is environmentally destructive. That the crypto industry is rife with fraud and manipulation. That a16z's promotion of crypto has contributed to retail investors losing money in crashes. These are legitimate criticisms that raise questions about the social impact of a16z's work. They genuinely believe in the potential of decentralized technologies. But their financial incentives are aligned with crypto prices going up, which creates at least the appearance of talking their book. Whether crypto will ultimately deliver on its promise of financial freedom and innovation or prove to be a speculative mania will take years to determine. But there is no question that a16z has been one of the most influential forces in making cryptocurrency a mainstream phenomenon. During this same period, they were also investing heavily in enterprise software and infrastructure. They backed Slack, the workplace communication tool founded by Stuart Butterfield. Slack launched in 2013 and grew virally as teams discovered that it was much better than email for internal communication. It was fast, searchable, integrable with other tools, and actually pleasant to use. Within 2 years, it had millions of users and was one of the fastest-growing enterprise software companies ever. A16z invested in Slack Series C in 2014, putting in $150 million at a valuation of about $1.1 billion. The investment in Slack showed their thesis about how enterprise software was changing. The old model was top-down sales where you convinced the CIO to make a big purchase. The new model was bottom-up adoption where individual teams started using a product because it was better, and then it spread throughout the organization. Slack exemplified this model. Slack went public in 2019 through a direct listing at a valuation of about $20 billion. It was later acquired by Salesforce for $27.7 billion in 2021. Another massive success that validated their enterprise software thesis. They also invested in PagerDuty, Databricks, Tanium, and dozens of other enterprise infrastructure companies during this period. The portfolio was becoming increasingly diversified across consumer, enterprise, mobile, crypto, and emerging technologies. This was deliberate. They believed that software was eating every industry and that opportunities existed everywhere. They did not want to be pigeonholed as a consumer internet firm or an enterprise software firm. They wanted to invest in the best founders and companies across all of technology. But this growth and diversification created challenges. With larger funds and more partners, they had to maintain their culture and decision-making speed. They addressed this by codifying their partnership principles and investment process. They wrote extensively about their philosophy, both internally and publicly on their blog. They created training programs for new partners. They developed tools and systems to help partners share information and coordinate without creating bureaucracy. One key innovation was their weekly meeting structure. Every Monday, all the general partners would meet to discuss what they were seeing in the market, which deals they were evaluating, and which companies in the portfolio needed attention. This meeting was not a decision-making committee. Partners still had authority to make their own investment decisions. But the meeting ensured that everyone had context on what others were doing and could provide input if they had relevant experience or concerns. They also continued building their operational team. By the mid-2010s, they had over 100 employees beyond the investing partners. They had recruiters who helped portfolio companies hire executives and engineers. They had marketers who helped companies with positioning, branding, and launch strategy. They had business development professionals who helped companies find customers and partners. They had technical experts who could advise on architecture, security, and scaling. This made a16z expensive to operate. They charged higher management fees than traditional venture firms to cover these costs. But they believed it was worth it because it made them more effective at helping companies succeed. And the results seemed to validate the model. Their funds were generating top quartile returns and they were winning competitive deals with founders who valued the support they could provide. But some wondered whether the model would continue to work as they got even larger. Could you really provide personalized support to hundreds of portfolio companies? Would the quality of service decline as they scaled? Would founders still perceive them as special, or would they become just another big venture firm? These questions became more pressing in the third era, from 2017 to 2020, when a16z expanded even further and faced new challenges around their role in the industry and their impact on society. This period saw the backlash against big tech. Facebook was implicated in spreading misinformation and enabling foreign interference in elections. Cambridge Analytica had improperly accessed Facebook user data. Twitter was criticized for allowing harassment and conspiracy theories. Amazon was accused of anti-competitive behavior and worker exploitation. Google faced antitrust investigations. The idea that technology companies were unambiguously good for the world came under serious challenge. A16z was not directly responsible for these problems, but as major investors in many of these companies, they faced questions about their role. Should they have pushed their portfolio companies to address these issues earlier? Did their focus on growth and scale contribute to the problems? What responsibility do investors have for the societal impact of the companies they fund? These were not easy questions. A16z's philosophy had always been to back founders and support their vision. They were reluctant to impose their views or push companies in directions the founders did not want to go. But this hands-off approach meant they had limited influence over product decisions or business practices that later proved problematic. They also faced internal challenges. Ben Horowitz announced in 2020 that he would step back from daily operations to focus on other interests, though he remained a general partner. This raised questions about succession and whether the firm could maintain its culture without the day-to-day involvement of both founders. Marc remained actively involved, but the firm was now run by a broader group of partners. They also faced competition from new venture firms that were copying their model. Many firms started hiring operational staff and marketing themselves as founder-friendly. Some raised large funds to compete for the same deals. Others offered even more favorable terms to founders. The competitive advantages that a16z had pioneered in 2009 were becoming table stakes by 2020. But they continued to execute. They invested in companies like Clubhouse, the audio social network that briefly exploded during the pandemic. They backed OpenAI in multiple rounds, betting that artificial intelligence would be transformative. They invested in Roblox, the user-generated gaming platform that went public at a $45 billion valuation. They invested in Carter, Fivetran, Deal, and dozens of other fast-growing startups. They also expanded into new fund strategies. They launched a growth fund to invest larger amounts in later-stage companies. They launched a bio fund to invest in healthcare and life sciences. They launched multiple cryptocurrency funds. By 2021, they were managing over $28 billion across multiple fund strategies. This made them one of the largest venture capital firms in the world. They had the resources to compete for any deal. They had the brand to attract founders. They had the team to provide support. But they also faced the classic innovator's dilemma. The things that made them successful initially, speed, conviction, founder focus, were harder to maintain at scale. And the market had become more competitive and more expensive, making it harder to generate the exceptional returns they had achieved in their early funds. The COVID-19 pandemic in 2020 created another historic moment that tested their model. As the economy shut down and markets crashed in March 2020, there was panic about whether startups could survive. Many venture firms slowed their investing, worried about valuations and uncertain about the future. A16z did the opposite. They accelerated their pace of investing. They believed that the pandemic would accelerate digital transformation. That companies in e-commerce, remote work, telehealth, online education, and digital entertainment would benefit enormously. That this was a moment to lean in, not pull back. They were right. The pandemic did accelerate digital adoption by years. Companies like Zoom, Shopify, DoorDash, and Peloton saw explosive growth. A16z's portfolio companies that were positioned for this shift thrived. And the valuations that had seemed high in March 2020 looked cheap by the end of the year as markets rebounded and technology stocks soared. But the pandemic boom also contributed to a broader bubble in technology valuations. By 2021, valuations had reached levels that concerned many observers. Startups with little revenue were raising money at billion-dollar valuations. SBACs were taking companies public that were not ready. Retail investors were piling into meme stocks and cryptocurrencies. There was a sense that valuations had become disconnected from fundamentals. A16z participated in this boom. They invested at high valuations because they had to in order to win competitive deals. They backed companies that would later struggle when the market corrected. In 2022, when interest rates rose and markets fell, many high-flying startups saw their valuations collapse. Some went out of business. Many had to lay off staff or raise down rounds. This was not a failure unique to A16z. The entire venture capital industry participated in the 2020 to 2021 bubble and is now dealing with the consequences. But it raised questions about whether the mega fund model was sustainable. When you are managing billions of dollars, you need to deploy a lot of capital quickly. This can push you to invest at prices that do not make sense. You can lose the discipline that made you successful initially. A16z would argue that they are still disciplined. That they only invest in their highest conviction ideas. That they have always been willing to pay up for the best companies. That over a 10 or 20-year time horizon, the entry price matters less than whether you back the right founders building genuinely transformative companies. Time will tell whether this is true. What is clear is that A16z has been one of the most influential firms in technology over the past 15 years. They have invested in dozens of companies that have become household names. They have helped shape the culture and practices of Silicon Valley. They have popularized ideas about how to build and invest in startups. They have trained a generation of founders and investors. But they have also faced criticism. That they prioritize growth over profitability, leading to unsustainable businesses. That they encourage founders to swing for the fences even when a more moderate approach would be wiser. That their focus on disruption has contributed to job losses and industry concentration. That their crypto advocacy has fueled speculation and fraud. That their influence in Washington through lobbying has protected tech company interests at the expense of public interest. These critiques point to a broader question about the role of venture capital in society. Venture capital has funded many of the innovations that have improved our lives: better communication tools, more efficient services, life-saving medical technologies, cleaner energy solutions. But it has also funded companies that have had negative effects: increased inequality, weakened privacy, spread misinformation, disrupted stable industries, created winner-take-all markets. Andreessen Horowitz exemplifies both sides of this ledger. They have funded companies that have created enormous value. But they have also funded companies whose impact is more ambiguous or clearly negative. How should we think about their legacy? What lessons does their story teach about venture capital, technology, and the role of capital in shaping society? To answer these questions, we need to look at their investment philosophy more deeply. What are the principles that guide how they invest? What frameworks do they use to evaluate opportunities? What makes their approach different from other firms? The first principle is that technology creates leverage. A small team of talented people building software can create products that reach billions of users and generate billions of dollars in value. This leverage is what makes venture capital work. You invest in companies when they are small and own a piece of the enormous value they create as they scale. But not all technology is equally leveraged. Some software is just incrementally better than existing solutions. Some technology is important but does not have strong network effects or barriers to entry. The key is to identify technology that can achieve exponential growth and defensible market positions. Marc's famous essay, "Why Software is Eating the World," published in 2011, articulates this thesis. He argued that in every industry, the best software company will win over time. That incumbents that do not embrace software will be disrupted. that the companies that understand how to build great software products and distribute them over the internet will have massive advantages. This thesis led a16z to invest in software companies going after traditional industries. Lending Club in consumer finance. Honor in home healthcare. Affirm in point-of-sale financing. OpenGov in government software. These companies were using software to provide better services at lower costs in industries that had not been technology-driven. The second principle is to back exceptional founders. Andreessen Horowitz believe that the founder is the most important variable in a startup's success. Great ideas are common. Execution is rare. And execution comes down to the quality of the founder, their vision, determination, ability to recruit, capacity to learn, willingness to do whatever it takes. They look for founders who have deep domain expertise, missionary zeal, and the ability to attract great people. They want founders who are building something they care about personally, not just chasing a market opportunity. They want founders who think from first principles rather than copying what has worked before. They want founders who can articulate a compelling vision but also adjust tactics based on reality. This focus on founders leads them to be flexible on terms. They will pay higher valuations if they believe in the founder. They will invest in areas outside their expertise if the founder is exceptional. They will back contrarian ideas if the founder can convince them. The founder is the starting point for every investment decision. The third principle is to concentrate capital in their highest conviction ideas. Many venture capitalists diversify extensively, investing small amounts in many companies to create a portfolio of options. The theory is that you cannot predict which companies will succeed, so you need many shots on goal. A16z takes the opposite approach. They believe that you can identify the best opportunities through deep diligence and pattern recognition. Once you have conviction, you should bet big. This means writing large checks, often leading rounds, and taking significant ownership positions. It means being willing to double down on winners even if the valuation has increased significantly. This concentrated approach creates a different return profile. When you are right, you generate enormous returns because you own a large piece of a successful company. When you are wrong, you lose more per deal. But if your hit rate is high enough, the concentrated approach generates better overall returns than the diversified approach. The Facebook investment exemplifies this. Putting $100 million into a single company in their first fund was an enormous concentration. But because they had conviction, they were willing to take that risk. And it paid off spectacularly. The fourth principle is operational engagement. This is where their model differs most from traditional VC firms. They believe that helping companies succeed is as important as picking which companies to invest in. That great founders still need help with specific challenges: recruiting, fundraising, product strategy, business development, marketing, regulatory strategy. Their operating partner team is designed to provide this help. When a portfolio company needs to hire a VP of sales, a16z can connect them with specialized recruiters and help them think through what qualities to look for. When a company is preparing to launch a product, a16z can help with positioning, messaging, and media strategy. When a company is navigating a crisis, a16z can provide advice based on having seen similar situations many times before. This operational support is not just altruistic. It is strategic. By helping companies succeed, a16z generates better returns. And by providing exceptional service, they win deals with the best founders who have multiple investors competing to fund them. The fifth principle is to think long-term and play the long game. Venture capital is a decades-long endeavor. You invest in a company that may take 10 or 15 years to reach an exit. You build relationships with founders that last across multiple companies and decades. You build a reputation in the industry that compounds over time. A16z has always emphasized that they are building an enduring institution, not just a series of funds. They make decisions based on what will strengthen the firm over decades, not just what will maximize returns on the current fund. This includes investments in brand, team, infrastructure, and relationships that may not pay off immediately but create long-term advantages. This long-term orientation shapes how they interact with founders. They try to be supportive even when companies are struggling. They try to maintain relationships even after exits. They try to build trust that makes founders want to work with them again on future ventures. These 5 principles, technology leverage, exceptional founders, concentrated bets, operational engagement, and long-term thinking, form the core of their investment philosophy. They are not unique to a16z. Many successful investors share some of these principles. But the combination and the degree to which they have operationalized them make a16z distinctive. But what about their actual track record? How have they performed as investors? This is harder to assess than you might expect because venture capital returns are not public and are measured over long time horizons. What we know is that their early funds, particularly Funds 1 and 2, have generated exceptional returns. The Facebook investment alone returned Fund 1 multiple times. Their investments in GitHub, Okta, Coinbase, Slack, and others have generated billions in gains. Industry sources suggest their early funds are top decile performers, among the best funds raised in their vintages. Their later funds, raised in the 2010s, are less clear. Some investments have been very successful. Roblox, Databricks, and others have generated strong returns. But many investments from the 2020 to 2021 period are still private and have marked down significantly. The ultimate performance of these funds will not be known for years. This is typical of venture capital. Early funds often outperform later funds because early funds are smaller, more focused, and benefit from the founding team's direct involvement. As firms scale and raise larger funds, it becomes harder to generate exceptional returns because you need more capital deployed and bigger outcomes to move the needle. The question for a16z is whether they can continue to generate top quartile returns at their current scale. They now manage over $40 billion across multiple fund strategies. This requires deploying billions of dollars per year into startups. This can push you toward paying high prices, lowering your bar, or investing in areas where you lack conviction just to put capital to work. A16z would argue that they remain disciplined. That they turn down far more investments than they make. That they only invest when they have real conviction. That their size allows them to support companies longer and through more rounds, which creates advantages. That their brand and resources attract the best founders, which improves their deal flow. But history suggests that maintaining exceptional performance at scale is very difficult. Sequoia Capital is one of the few firms that has done it across multiple decades. Most firms that were top performers in one era regress toward average in later eras. Whether a16z can buck this trend remains to be seen. What is undeniable is their influence on the venture capital industry. They have changed how VCs operate. The idea that you should provide operational support to portfolio companies has been widely adopted. The idea that you should market yourself to founders has become standard. The idea that founder-friendly terms can be a competitive advantage is now common. They have also changed how founders think about venture capital. Founders now expect more from their investors than just money. They expect help with recruiting, strategy, and connections. They expect investors who understand their business deeply. They expect partners who will support them through challenges rather than replacing them when things get hard. Some of these changes are positive. Founders having more power and better support is generally good. But some observers worry that the founder-friendly approach has gone too far. That founders are given too much control and not enough accountability. That boards are too deferential to charismatic founders even when those founders make poor decisions. That the venture capital industry has become too focused on narrative and valuation growth rather than on building sustainable businesses. These concerns were highlighted by high-profile failures like WeWork, where the founder was allowed to engage in questionable behavior and make poor decisions for years before finally being removed. A16z was not an investor in WeWork, but they have backed founders who have faced criticism for their management style or business practices. This raises the question, what responsibility do investors have when they back founders who behave badly or build companies that have negative social impacts? A16z's philosophy emphasizes supporting founders and not imposing their views. But does that become complicity if a founder is doing something harmful? These are difficult questions without clear answers. Investors need to balance supporting founders with providing oversight. They need to allow experimentation while preventing recklessness. They need to back bold visions while ensuring basic ethical standards. Getting this balance right is hard, and different investors will draw the line in different places. A16z has generally leaned toward giving founders more latitude. This has allowed them to back unconventional founders and contrarian ideas that other investors would not support. But it has also meant that they have been associated with some controversial companies and founders. As we think about their legacy, we need to consider both the innovations they funded and the problems those innovations created. The ride-sharing companies they backed have made transportation more convenient but have also created precarious gig economy jobs. The cryptocurrency companies they backed have enabled new forms of financial inclusion but have also facilitated speculation and fraud. The social media companies they backed have connected billions of people but have also enabled misinformation and polarization. This duality is inherent to innovation. New technologies create both benefits and harms. The question is whether the benefits outweigh the harms, and for whom. Venture capitalists tend to focus on the upside because that is how they make money. But society needs to grapple with the full consequences. A16z has been more thoughtful about these issues than many venture firms. They have written extensively about technology's role in society. They have engaged in policy debates about regulation of tech companies. They have advocated for positions they believe will enable innovation while addressing legitimate concerns. But their economic interests inevitably color their views. They benefit when tech companies grow and are not heavily regulated. This creates at least the appearance of self-interest in their policy advocacy. Looking forward, A16z faces several key questions. Can they maintain their performance at their current scale? Can they successfully transition leadership from the founding generation to the next generation of partners? Can they continue to evolve their model as the market changes? Can they address legitimate concerns about their portfolio company's social impact while maintaining their founder-first philosophy? How they answer these questions will determine their legacy. If they can continue to generate strong returns and fund transformative companies for another decade, they will be remembered as one of the great venture capital firms. If their returns regress and their influence wanes, they may be remembered as a firm that was exceptional for one era but could not adapt to the next. But regardless of their future trajectory, their impact on venture capital is already secure. They proved that the operating partner model could work at scale. They showed that founder-friendly terms could be a competitive advantage. They demonstrated that marketing and brand building mattered in venture capital. They popularized frameworks and ideas that shaped how Silicon Valley thinks about building companies. They also showed that former founders and operators could become great investors. Before A16z, most successful VCs came from finance or consulting backgrounds. Marc and Ben proved that operational experience could be as valuable or more valuable than financial expertise. This opened the door for other founder-turned-investors to start their own firms. The lessons from their story are both specific and general. Specifically, they show the power of building something differentiated in a crowded market. When they started, there were already many good venture capital firms. But by offering something truly different, operational support at scale, founder-first approach, technical depth, they created a competitive advantage that allowed them to win deals and generate returns. More generally, their story shows the importance of conviction and contrarian thinking. Their best investments were in companies that seemed overvalued or in areas that seemed speculative. Facebook at $10 billion. Coinbase in cryptocurrency. Instacart in grocery delivery. These were not consensus bets. They required belief in a future that most investors did not see. Their story also shows the power of brand and marketing in venture capital. Most VCs are relatively anonymous outside the industry. A16z made their partners into public intellectuals. Marc's blog and Twitter presence. Ben's book and speaking. Their podcasts and media appearances. This visibility created awareness and credibility that translated into better deal flow. But perhaps the deepest lesson is about the nature of venture capital itself. Venture capital is ultimately about finding and supporting the people who will build the future. It requires pattern recognition to identify exceptional founders. It requires conviction to back contrarian ideas. It requires patience to support companies through years of uncertainty. And it requires humility to acknowledge that you will be wrong more often than right. A16z has done all of these things well. They have found exceptional founders like Brian Armstrong, Stuart Butterfield, and many others. They have backed contrarian ideas like cryptocurrency and enterprise communication software when they were not fashionable. They have supported companies through multiple rounds and years of development. And they have been honest about their failures and what they learned from them. As we close, it is worth reflecting on what their story tells us about the relationship between capital and innovation. Venture capital plays a crucial role in funding new technologies and businesses. Without access to patient capital that is willing to accept risk, many innovations would never be developed. The transistor, the internet, biotechnology, renewable energy, artificial intelligence, all of these required long-term investment before they became profitable. But venture capital also shapes innovation in particular directions. VCs fund technologies and business models that promise exponential growth and venture-scale returns. This biases innovation towards software and other capital-light businesses that can scale quickly. It biases innovation toward winner-take-all markets where network effects create monopolies. It biases innovation toward consumer and enterprise applications rather than toward basic research or social goods that are harder to monetize. A16z exemplifies these patterns. Their portfolio is heavily weighted towards software businesses in markets that can become very large. They have funded relatively little in areas like climate technology, educational innovation, or public infrastructure, not because these areas are unimportant but because the return profiles are less attractive. This is not a criticism of A16z specifically. They are operating within the incentive structure of venture capital. Their job is to generate returns for their limited partners, who are pension funds, endowments, and wealthy individuals. Those stakeholders expect and deserve strong financial returns on their capital. But it does mean that venture capital alone cannot solve all of society's problems. Some challenges require public investment, patient philanthropy, or business models that prioritize social impact over financial returns. The venture capital model is extraordinarily powerful for funding certain kinds of innovation. But it is not the right tool for everything. A16z understands this. They have been thoughtful about the limitations of their model and have experimented with ways to extend it. Their biofund tries to apply venture capital to life sciences despite longer timelines and higher capital requirements. Their cryptocurrency funds bet on technologies that could enable new forms of organization and finance. Their research initiatives explore how to apply technology to problems like housing, education, and healthcare. But ultimately, their success is measured by the returns they generate for their investors. This is as it should be. Venture capitalists are not philanthropists or policymakers. They are investors. Their contribution to society comes through funding innovation and helping founders build companies that create value. The question is whether the value they create is distributed fairly. Whether the innovations they fund make life better for most people or primarily benefit a narrow elite. Whether the companies they build are structured to share prosperity or to concentrate it. These are questions that extend beyond A16z to the structure of capitalism itself. Andreessen Horowitz has been one of the most successful venture capital firms of the 21st century. They have generated billions in returns. They have funded dozens of important companies. They have influenced how venture capital operates. They have trained a generation of founders and investors. They have popularized ideas that shaped how Silicon Valley thinks. But they have also been part of a technology industry that has created inequality, enabled harmful products, and resisted accountability. They have profited enormously while many people have been left behind. They have advocated for policies that benefit their portfolio companies even when those policies may not serve the public interest. How we judge their legacy depends on how we weigh these considerations. If you believe that innovation and economic growth are the paramount goals, then A16z has been extraordinarily successful. If you believe that we need to consider distributional impacts and social consequences, then the picture is more mixed. What is clear is that their story matters. It matters for what it tells us about technology, about investing, about building institutions, and about the role of capital in shaping society. It is a story of ambition, conviction, risk-taking, and success. But it is also a story of trade-offs, unintended consequences, and unanswered questions. As the technology industry evolves and as society grapples with the impacts of the innovations that venture capital has funded, the full meaning of Andreessen Horowitz's work will continue to unfold. They are still in the middle of their story. The companies they are backing today will shape the world of tomorrow. Whether that world will be better or just different remains to be seen. What we can say is that they approached venture capital with ambition and innovation. They built something new rather than copying what existed. They took big risks and had big successes. They changed their industry and influenced their era. That is more than most firms achieve. Whether it is enough depends on what you hope they would accomplish.